the Mastery Mindset podcast channel. The Wealth Series. Master your mind and unleash your potential. Hey there, welcome to the Mastery Mindset podcast channel, the go-to place for practical insights on personal finance and investing. Today, we're tackling a topic that can truly transform your financial landscape. Dividend investing made easy. Earn passive income now. So, grab a cup of coffee, get comfortable, and let's dive into the world of dividend investing without getting too complex. Alright, let's delve into the fundamental principles of dividend investing. Think of it as the financial equivalent of receiving a consistent paycheck from your investments. Imagine you decide to buy shares of a company. Now, typically, when people talk about investing, they focus on the hope that the stock's price will go up. But with dividend investing, it's like getting an additional payday. Picture this. When you own shares of a company that pays dividends, you're not solely reliant on the stock's value increasing. In fact, you become entitled to a portion of that company's profits on a regular basis. It's like earning money while you sleep. Now, let me illustrate this concept with a straightforward example. Think of dividend investing akin to owning a rental property. When you own a property, you receive monthly rent payments, adding a steady stream of income to your bank account. Over time, the value of the property also tends to appreciate. Similarly, in the world of dividend stocks, you receive regular payouts, dividends, acting as a consistent income stream, alongside the potential for the stock's value to increase over time. So, just like you'd appreciate both the monthly rent and the increasing property value in real estate, dividend investing offers you the dual benefit of regular income and the potential for capital appreciation. It's a strategy that aligns your money with your goals, allowing it to work for you in more ways than one. Now, let's explore the art of selecting the right dividend stocks for your investment portfolio. It's crucial to recognize that not all dividend stocks are cut from the same cloth. What you're after are stocks from companies with a proven and consistent track record of paying dividends. In this financial journey, stability and growth become your best friends. Seek out companies that boast a history of financial stability. Those that have weathered economic storms and still manage to reward their investors with dividends. But here's the kicker. It's not merely about chasing the highest yield. While a high dividend yield may seem tempting, it's essential to consider the sustainability of those dividends. You wouldn't want to invest in a company just for its momentarily attractive dividend payout, only to see it falter in the long run. Instead, we're aiming for that sweet spot where income meets growth. Think of it like planting a tree. You want a seed that not only produces fruits, dividends, but also grows into a strong, flourishing tree. Capital appreciation. Companies with a healthy balance of dividend payouts and a commitment to growing their business offer you the best of both worlds. So, when you're on the lookout for dividend stocks, think beyond the immediate returns and consider the long-term potential. It's about building a portfolio that stands the test of time, providing you with a reliable income stream while nurturing the growth of your invested capital. Keep your eyes on that sweet spot, where income and growth harmonize to create a robust and rewarding investment strategy. Now, let's unravel the fascinating world of supercharging your dividends through a game-changing strategy. Dividend Reinvestment Plans, or DRIPS. Picture this as putting your dividends on autopilot, creating a perpetual cycle of wealth creation. DRIPS work like this. Instead of pocketing your dividend earnings, they automatically get reinvested to acquire more shares of the same stock. It's a financial mechanism that sets compounding magic into motion. As you reinvest your dividends, you end up with more shares in your portfolio, and these additional shares, in turn, generate even more dividends. It's a beautiful cycle of wealth building that gains momentum over time. Let's break it down with a practical example. Say you invest $1,000 in a company with a 4% dividend yield. After a year, you've earned $40 in dividends. Now, with DRIPS in action, that $40 doesn't just sit idle. It goes back to work for you. it automatically gets reinvested, buying more shares of the same company. Now, here's where the magic happens. Those new shares start generating their own dividends. So, not only are you earning dividends on your initial investment, but you're also earning dividends on the reinvested earnings. It's a compounding effect that snowballs over time, magnifying your wealth accumulation. Imagine this process repeating itself year after year. Your initial investment, coupled with the power of compounding through drips, could result in a substantial portfolio growth. It's not just about the dividends you earn today, it's about building a sustainable and ever-growing income stream for your future. So, by embracing drips, you're not just an investor, you're a wealth conductor orchestrating a symphony of compounding magic. It's a strategy that aligns perfectly with the concept of making your money work smarter, not harder. As we navigate the financial landscape, let's keep in mind the beauty of this cycle and how it can elevate our journey to financial prosperity. Now, let's have an open conversation about the unavoidable factor in investing: risk. While no investment is entirely risk-free, the key lies in our ability to manage and navigate through it successfully. Think of risk management as your financial compass, guiding you through the highs and lows of the market. One of the most potent tools in our risk management arsenal is diversification. The saying, "Don't put all your eggs in one basket," holds true in the investment world. Instead of concentrating your investments in a single sector or asset, diversification involves spreading your funds across different sectors, industries, and even asset classes. Consider this scenario. Imagine having all your investments solely in the technology sector. If the tech industry experiences a downturn, your entire portfolio takes a hit. However, by diversifying, you're essentially creating a safety net. You might have some investments in technology, but you also have exposure to healthcare, consumer goods, and perhaps even other sectors. This diversified approach acts as a shield against market fluctuations. While one sector may be facing challenges, another might be thriving, helping to balance out the overall performance of your portfolio. It's a bit like having a well-balanced meal. You're getting a mix of nutrients from different sources, ensuring your overall health. So, as you navigate the investment landscape, consider the sectors you're invested in as different pillars holding up your financial fortress. By spreading your investments strategically, you're not just managing risk, you're also setting the stage for more consistent and reliable returns over the long term. Remember, risk is an inherent part of investing, but how you manage and mitigate it can make all the difference. Diversification is your toolkit for building a resilient and well-rounded investment strategy that stands strong against the uncertainties of the market. As we move forward in our investment journey, let's keep our portfolios diverse and our risk managed. Now, let's dive into the world of taxes. A topic that might not be the most thrilling, but it's a crucial element of successful dividend investing. Fear not, though, I've got some practical tips to make this aspect a bit more digestible. Did you know that the tax treatment of your dividends can significantly impact your overall returns? It's true! Understanding the tax implications of your investments is like having an additional tool in your financial toolkit. Let me shed some light on a game changer. Qualified dividends. Qualified dividends often receive preferential tax treatment. Essentially, this means that the government offers a lower tax rate on these dividends compared to other forms of income. It's a win-win for investors. By holding stocks that pay qualified dividends, you're not just earning income, you're also potentially reducing your tax burden. Now, here's a practical strategy to consider. Think about where you hold your dividend-paying stocks. Tax-advantaged accounts, such as individual retirement accounts, IRAs, can be your best friend. When you hold dividend stocks within an IRA, you're essentially sheltering those earnings from immediate taxation. It's like putting your dividends in a financial safe, allowing them to grow and compound without being taxed year after year. Let me illustrate this with a real-world example. If you're in a higher tax bracket, holding dividend stocks in an IRA can help defer taxes until you withdraw the funds in retirement, potentially at a lower tax rate. It's a strategic move that aligns your investments with tax efficiency. So, as you embark on your dividend investing journey, take a moment to understand the tax implications. Consider the types of dividends your investments generate and explore the benefits of holding them in tax-advantaged accounts. It's a proactive step that not only maximizes your after-tax returns but also positions you for a more tax-efficient and financially savvy future. Remember, taxes might be a part of life, but with the right strategies, you can navigate them in a way that optimizes your investment outcomes. As we move forward, let's make informed decisions that not only grow our wealth but also protect it from unnecessary tax burdens. Wow, we covered a lot today. From the basics of dividend investing to real-life success stories, I hope you're feeling inspired to take action. Remember, it's about consistency and patience. If you found value in this episode, give it a thumbs up, share it with your friends, and don't forget to hit that subscribe button. And as always, keep that mastery mindset alive. Until next time, happy investing. Thanks for tuning into the Mastery Mindset podcast channel. If you have any questions or want more insights on specific topics, drop them in the comments below. Your feedback fuels the content on this channel. And remember, the journey to financial mastery is a marathon, not a sprint. Stay focused, stay curious, and stay invested. I'll catch you in the next episode. Take care.